is really the only place where you can watch this kind of stuff happen in real time. You can watch prices change immediately as supply and demand change. Now, prices move all the time when supply and demand change, but there's always a lag because we're humans, and it takes time for us to realize, hey, this thing isn't selling as much. I need to lower the price, or I need to change this price. So this does happen in everywhere. It just takes a little bit longer. The stock market, because it's so digital and because it's so there's so much information, you're watching it happen in real time versus the lag of reality that we normally see. So one of the reasons I like it. Also, I think it's a really interesting topic based on the number of questions you guys had. It sounds like you're kind of interested in it as well, which is always good. That's another good reason to start out with it. So we covered a whole bunch of topics, and I basically made up some numbers of almost every one of those definitions that we covered. And this is what you're looking at right now on the whiteboard. And made up each one, go over each one real briefly, and then kind of ask you some questions about those to give you an idea of basically how to interpret this information. So the purpose of this quiz is to interpret this information. Because I always look at, if you want to get involved in the stock market, the first thing you have to do is, one, understand the terminology, and then two, understand what the data is telling you. That will then lead to bigger things like, hey, where should I invest? What should I do? How should I answer these questions? So we're starting with the basics. Everybody always wants to jump right in, open a Robinhood account, and start buying GameStop, which is fine, but understand the terminology first. That's kind of my whole thing. So if we start up here, we've got the current price. And if you remember the current price, this is basically the price of the very last trade that happens. And as we watched in real time, this is constantly changing. So we're going to look at this as a snapshot in time. So the information you're looking here is a snapshot in time. So we're going to say the current price is $10. All that means is the very last trade that went through, the price is $10. The last price was $10. That doesn't mean that the next price is going to be $10. That doesn't mean the price before that was $10. That's just the very last price that occurred. So the current price is $10. Then we have the bid and the ask. This is, remember, if you recall, this is your supply and your demand. So the bid is your demand price. Somebody out there right now, according to this data, is saying, hey, I would like to buy, I don't know, we're not going to get into how many shares. I would like to buy shares of this, the stock, whatever it is, and I'm willing and able to pay $9.15. And the ask price is the opposite. The ask price is your supply price. This is somebody saying, hey, I own this stock, and I'm willing and able to sell it right now for $11.05. So if you happen to offer me $11, I'm going to say no, because I want $11.05. If you offer me $11.05, we will now have a trade. We will now have a trade. So that's your bid price and your ask price. Bid is your demand price. Ask is your supply price. Those change, and we watch those change as well, just as quickly as the current price. But like I said, this is a snapshot. Questions on those three: current price, bid price, and ask price. All right. So we went to the day's range. This is simply the lowest price and the highest price that the stock sold for on this day. So at some point in this day, we can kind of look right here. At some, oh, I'm using the wrong, there we go. At some point in this day, the stock traded for $5. And at some point in this day, the stock traded for $21.40. And there was probably a whole bunch in between. So the range is just the low price and the high price for the day. And also, if you remember with the range, this isn't necessarily in order. It wasn't necessarily that it went to it started at $5 and went up to $21. It's not necessarily saying that it started at $21.40 and went down to $5. At some point, somebody bought this and sold this for $5. And at some point in the day, somebody bought this for $21.40. So that's your day's range. If you remember, if you took like basic statistics and stuff like that, you learned about range. You probably learned about this when you did statistical analysis. So you learned about mean or the average, median, the middle number, mode, the most common one. And you probably looked at range as well. These are all kind of basic data analysis terms. So that's your days range. So your volume, this is the number of shares that were traded during the day. So in this day, the volume was 220,000 shares. If you remember, we compared a couple different ones. We looked at SenseTech, and there was like 25,000 shares. And then we looked at Ford, and it was like 179 million shares. So your volume tells you a lot about which stocks are more popular, which stocks are less popular. All right, then you've got the open and close price. So we're going to assume all this information is after the market is closed. So what this tells you is the open price. This is the very, very first trade of the day, was the open price. And the close price was the last trade of the day. So if, let's say, the market is currently open, then the close price would be yesterday. So what was the last price of yesterday's trades? So that's open and close. So think about open and close. This is first trade, last trade of the day. Doesn't tell you a whole lot. These numbers aren't terribly important, but they do have them on there. All right, your 52-week range. This is very similar to your days range, except now instead of looking at the trading day between 9:30 and 4, now we're looking at the previous 52 weeks. So in the previous 52 weeks, what was the absolute lowest that the stock traded for? And what was the highest the stock traded for on any trade on any day? So in this case, the 52-week range was traded for a low of $5 and for a high of $98. Yeah, you can look at this. The term, and you're using the term stability, which I know exactly what you mean. We look at the term, or in investing, we use the term volatility. So how volatile the stock is, how much it goes up and down. So a stock that is between $5 and $98, that's a really highly volatile stock. This is all, if you look at this, something either really, really good or really, really bad happened here. Because again, you don't know if it went from 5 to 98 or 98 to 5. And again, I just
also be something that has just started being sold and they weren't sure what the prices should be.
Yeah, and that happens too after the IPO. We talked about the IPO, the initial public offering. If you see a huge spike in price after the IPO, it could definitely be that, which would also mean the stock is very volatile. The price changes a lot. So there's a lot of things that can happen to make a price change like this. And like I said, I just made these numbers up. So something like $5 to $98, although it definitely can happen, this is not a common occurrence that you would have this big of something happen in a year. And like I said, it does happen. And this can happen, you could have a few dozen stocks where this occurs, but that's a few dozen out of 4,500 publicly traded. So this is a big number, but it can happen. Yeah, like I said, if you see that, that's where you're definitely going to want to say, okay, before I get in the stock, I want to look and find out what happened. Did this stock just jump up to $98 yesterday from $5? In which case, am I maybe too late to get in? Or was the stock $98 last week and now it's $5? In which case, that could also be something really, really bad. So all this tells you is, hey, should I look into this? Is this something that's going to jump out at me? And not to necessarily say this is going to say to buy it or not buy it, but this just tells you, hey, you want to look into what happened. You should always look into previous prices anyway, but what happened here? What occurred to make this big leap happen? All right, your average volume. This is where you take a certain number of days, and this is where, and we're not going to get this in depth in the quiz, but your average volume, this could be anywhere from 2 weeks to 3 months, where they take the number of the volume for each day. So we talked about volume, take the volume of each day for a certain set period of time, divide it by the number of days, and you get your average volume. So this just tells you approximately how much, what is the typical day of trading for a stock like this. So if you recall, when we looked at Ford, it was I think the average day was like 65 or 70 million, and the day we looked at it was 179 million. That's a big jump. right there, that tells you something is happening today that's out of the ordinary. And again, that could be out of the ordinary good or out of the ordinary bad. And with Ford, it was out of the ordinary good. But, we looked at Ford and it was triple the average volume. So the day's volume, and this was early in the day, was triple that of the average volume of stock trade. So that right there tells you something's happening right now because this is way different. So that's what average volume is. Again, hopefully you've learned about averages. A lot of these terms you would have learned if you took statistics. You might have even covered this in early algebra, things like that. We're looking about ranges, averages, those kind of things. All right, shares outstanding. I kept this number low because you're going to require to do some math on this. And honestly, I'm not interested to make you get a question wrong because you didn't put enough zeros on 4.6 billion, which is how many shares Tesla had, or not Tesla, what do we look at? Apple. Apple has 4.6 billion shares outstanding. I'm not going to make you multiply a number by 4.6 billion. I want you to understand the concept, not, this is a conceptual class, not a math class. So shares outstanding, yes, this is unrealistically low, but it's unrealistically low for the reasons of this quiz. So we're going to say shares outstanding are 100. This means that there's a total of 100 shares that exist that you and I can trade or that are available for trade. That doesn't mean that people are willing and able to sell them if they own them. That just says that 100 shares exist in reality, and people can trade those 100 shares as they please. That's what those shares outstanding mean. Any questions so far? All right. Dividend, remember this is a cash payment from the company to shareholders. So this is kind of like the owners of a company taking profits and using them for themselves rather than reinvesting them into the company. So in this case, the dividend is $1, and that happens once per year. And again, I'm using these numbers to keep things nice and round and easy. That means that if you own 1 share of the stock, you will receive $1 in cash. So then we have the 2 dates that tells you when you have to own it and when you receive the money. So your ex-dividend date, this is the date that you have to own the stock on in order to receive that dividend. So if you own the stock on October 15th, you will receive $1 for each share that you own. So that's your ex-dividend date. You have to own it for the day. And again, we're not going to get into that specific, but that's what it says. If you own it on this date, on October 15th, you will receive in cash $1 per share, and you'll receive that on November 1st. So in this case, we're looking at about a 2-week lag between when you or when you qualify to receive it and when you actually receive it. And the reason for these numbers being different is this comes from kind of a long history of the way it used to be was the corporation would get a report of here is everybody that owned the stock on this date. And, if we go way, way back to, not even way that far back, to the 1980s, the corporation would then have to write a check, if you remember those or witness those things in the Smithsonian Institute. They would actually have to write a check and mail it to the individual. So that's why you have this time lag, because those things used to take time. Now that everything's digital, they could very well, they have the capability of saying your ex-dividend date is October 15th, so you're going to receive the payment the very next day. We can do that kind of stuff now, but these things take a long time to change. So you'll probably always see some kind of time difference between the ex-dividend date and the dividend payable date. That was a lot of information you don't really need to know, but that's a question that comes up sometimes. Why don't I just get that payment right away? And that just comes from a history of not being able to get those payments out right away. All right, so this is most of the terminology that we covered. We missed a couple things because there's a couple mathematic problems. That's where I'm going to ask you some questions about this stuff to see if you understand this. So before we get started, any questions on the terminology before we look at some how we can interpret this? All right. So here's your first question, and this is just a review question here. What is the not the definition of market capitalization, but what is the actual market cap of this? Take a couple seconds, check through your notes, see if you can do the math.
It's the number of shares times the stock price, and
Okay,
that
so the
equals
number
the
of
value of
shares.
the corporation.
Yeah, so market capitalization, this is the value of the corporation. So we take the number of shares outstanding, which is 100. So we have 100 shares. We multiply that by the current stock price, which is $10. And look at that, I made it nice and easy. 100 times 10. It's $1,000. Obviously, this is not a realistic number, but again, if you understand the concept, then you can figure out the market capitalization for Apple. You just have to be able to multiply 170 times 4.6 billion. And I'm not too interested to see if you can remember how many numbers are in a billion or type all those big numbers in a calculator. This is the concept right here. So market cap for this is $1,000. And all this tells you is what is the market value? How much is this corporation actually worth? Because if you think about it, the shares of stock, this is ownership of the corporation. So this is all the different parts of ownership of the corporation broken up into even parts times how much each one of those parts is worth. So if you wanted to buy this company outright, you would need $1,000. That's pretty cheap. All right, so that's market cap. You're going to see a market cap question on your quiz. So it's number of shares multiplied by current price. And on the quiz, I kept the numbers pretty easy as well. Like I said, this isn't a math class, this is a concept class. All right. So this is going to be a question on terms that we did not cover over here, but terms that we did cover in class. So if you remember, we talked about the different types of gains you can have, realized and unrealized gains. So let's say that you purchased, we'll just do more terms. Let's say you buy 10 shares at $5 each. So you buy 10 shares at $5 each, and you still own them now. What type? Now this is the key. What type of gain or loss do you have? And if you know the answer, feel free to yell it out.
I think that would be an unrealized loss.
That is correct. You would have an unrealized gain. But the only term that I was concerned with here is unrealized. Because the reason it's unrealized is, remember, you have realized and unrealized gains and losses. And unrealized means that it's kind of a theory. Think of this as like a theoretical gain or loss. So you bought these at $5. Now they're worth $10. But the amount of cash you have hasn't changed. The only thing that's changed is this value of the thing that you own. So in this case, you have an unrealized gain of $5 per share. Now, what would happen if you sold those shares right now? What kind of gain or loss would you have?
Realized.
You would have a realized gain because you bought something. So you bought 10 shares at $5, and then you sold 10 shares at $10. So you would have a $50 realized gain. The amount of cash that you have actually increased by $50. that becomes a realized gain. I always like to say that, and this is, kind of a way to remember this, you can't pay bills with unrealized gains. And also, you won't go broke with unrealized losses. So you can't pay bills with unrealized gains.
So Adam.
Yeah, go ahead.
So to realize there'll be $50, you say? Realize?
You would have a realized gain of $50.
Okay, cool. Thank you.
And what you're going to see in the questions in the quiz, I'm just going to ask you specifically what type. So you don't have to answer any, it won't be a dollar amount. It'll simply be what type of gain or loss have you seen? All right, in the past year, in the past 52 weeks, what is the highest price this stock sold for?
$98.
$98. And we know that because of our 52-week range. So the highest price this sold for in the last 52 weeks was $98. How many shares got sold today?
2,200? No. 220,000.
220,000, correct. I knew what you meant. So 220,000, that's your volume. How many shares got sold today? Asking you the volume of shares. All right, somebody out there in the world is willing to sell their shares of this stock. How much do they want for it?
$11.05.
$11.05, correct. That's your ask price. So where the term ask comes from is somebody wants to sell this, they're asking people to pay $11.05. All right, somebody out there in the world is willing to buy this stock. How much are they willing to buy this stock for?
$9.15.
$9.15, correct. That's your bid. If you think about an auction, if you're familiar with auctions, people putting in bids for something, that means they want to buy it. That's a good way to, again, to remember that. Buy it, that is they're putting in a bid. I'm willing to pay $9.15 for this. All right, if you buy, or let's say, okay, if you own, no, let me say here, I'm gonna rewrite this down here. Sorry. You buy 100 shares on October 1st. You sell 100 shares on October 20th. How much money do you receive on November 1st?
$100.
That is correct. How'd you figure that out? Which is the correct answer, but how'd you figure out $100?
By the ex-dividend date and the dividend payable date.
Okay. So that's kind of the key to this one is if we start talking about dates in these questions, well, that's a pretty specific piece of information to know. So if you buy the shares on October 1st, you buy 100 shares and you sell them on October 20th. Well, if you buy them on October 1st and you sell them on October 20th, well, you own them on the ex-dividend date. That means on November 1st, which is dividend payable date, you'll receive $1 for each share because your dividend is $1. There's 3 pieces of information in this question. So November 1st, you will receive $100. Anybody not see how we got that? All right.
No, can you show it? Can you show the math problem? Or
So it's $100 because you've got 100 shares, and each share pays $1 dividend per year.
Okay.
Now, what if we change this a little bit? No, let's use this. We're gonna use different color pen so it stands out. I'm gonna get my money's worth out of this whiteboard thing. So instead of October 20th, we change the date to October 10th. Now, how much you receive on November 1st?
Get Jack.
You wouldn't get jack. That would be a correct answer too. So in this case, you wouldn't get anything because you didn't own the stock on October 15th. So those questions are basically seeing if you understand dividend, how dividends are calculated, and understanding dividend date and the dividend payable date. Anybody not understand that? All right. What's the lowest price the stock sold for today?
$5.
$5. Oh yeah, we'll go put this back up. There's your day's range. It tells you the highest price and the lowest price. Can you tell what part of the day this sold for? Where it sold for $5? No.
Not unless you have a graph.
If you had the graph, you could definitely tell then, but based on this information only, you don't know when that $5 occurred. So, but you do know that that was the lowest price for the day. All right. Last question.
I've got
Yeah,
a question about the previous one.
Yep.
Because of when the dividend payable date is, the stock of the price fluctuates like cyclically. Can you see that in like a 52-week range?
Oh yeah, you can pull up. Let me show you. Since you asked